All right, all right. Looks like we've got a number of our main speakers here with more to come. We'll be cycling in and out of people today, folks. We've got a lot of great speakers coming through. So I'm going to go ahead and just kind of give a basic layout of who we got speaking. No other experts exist on the Twitter world in any way, shape, or form than these folks. So I'm just really grateful to have all of you here. Can't thank you enough for coming. In no particular order, I'm just going to run through our list. Go ahead and plug something if you got something to plug after I introduce you. Otherwise, we'll get this thing started. So let's move on to our boy Fed Guy 12, Joseph Wang. He headed the trading at the Fed's open desk. He has a really good book called Central Banking 101, probably the best guy out there to explain the complexities of the Fed operations. How are you doing today, Joe?
I'm doing well. Thanks so much for inviting me.
Up next, we got Darius Dale. Had a little bit of banter with him right at the beginning here. Founder and CEO of 42 Macro, the leading macro risk management advisor. Super honored to have you here, man. Been looking to have you on here for a while. How are you doing?
Nah, man, just plugging good vibes, dude. Absolutely. It's a blessing to be here, man. Appreciate you.
Appreciation's all ours, man. Macro Al, had him before, we got him again. A great Substack on macro and a great podcast that's regularly updated. You know more about macro than hell, just about anyone. I know you've got a lot of views on recession and bonds, an expensive dollar, and I know you know a little bit about pizza. Welcome, man. How you doing?
I would say by far my biggest skill is pizza. Macro is just a side. But we're entering this Fed meeting with the spread between 10-year and 2-year government bond yields at negative 28 basis points. It's more negative than before the great financial crisis. So let's see if Powell sends it to minus 50 tonight, or what is he going to say about the yield curve slope.
Perfect. Thank you so much, man. Mr. Blonde Macro, man, got you back as well. You've always been a strong voice on macro. You were the first to speak about the pullback and growth in 2021's summer, and spot on in the execution thereof. You also got a great Substack that everyone should subscribe to. What's going on, man?
I'm good, Will. How you doing?
We're all chilling, man. Just ready to start getting some info out to folks. Thanks for coming.
No problem. Thanks for having me.
Might cut out again there. Sorry about that, guys. We've got Christian here again, man. CEO of Tribeca Trade Group. Great handle on micro aspects of macro econ. Can speak about pretty much anything regarding food prices, oil companies, and more. Happy to have you as always, Christian. How are you doing?
Hey, very good. Happy Fed Day. And thanks for having me on. I appreciate it. Looks like Fed Fund Futures pricing in the full 75 basis points. And September, which we don't have another meeting until September, another 60 basis points priced in. So I like to see where these things are at in terms of expectations. And I like that there's a hawkish tone going into it.
Perfect. Thank you. And that's actually right where we're going to start. First, we got Brad Freeman here as well. He's a regular appearance. Love having you here again, man. How are you doing?
It's great to be here. Flattered to be in this panel of titans. Really, I mean, the credentials are making me feel a little bit intimidated, but I will do my absolute best to keep up.
Oh man, tell me about it.
just excited to dig in about this really weird no man's land we're in with really high levels of inflation, some break-even inflation levels looking a little bit better on a 5 and 10 year basis, but then things like, just to give you a data point and then we'll move on because this is just supposed to be an introduction. Philadelphia Fed manufacturing at negative 12.3 versus negative 2.5 expected last week. So yuck there. So really weird times where in this world of two Fed mandates, one still looks pretty good in terms of employment, although showing a lot of cracks, and we see layoff news every single day. And then the other one in terms of inflation, I mean, with employment still looking as good as it does, it seems as though the Fed is rightfully focused on taming inflation. So I'm sure that's what we're going to be talking about, and really excited to dig in. And again, flattered to be included with all these people.
Yes, sir. Thanks for coming. Last but not least in our current lineup, before we start cycling folks through, Northman Trader, Sven, another great newsletter writer, another great trading service. And I hear you kind of butt heads with the idea of kind of how Operations run these days. How are you doing, buddy?
I'm doing great. Thanks for having me on. Appreciate being on with everybody else here. This is a great group. And confession, I like to see the Fed sweat. And I guarantee you they're sweating this because they're trying to bring down inflation at the same time without breaking anything. And I think it's a really challenging task for them.
Always love to have that viewpoint, man. So speaking of sweating, let's talk about the rate hike. First of all, I just kind of want to start there, and we can actually start with you, Sven. Last time we all spoke, CPI was at a record-breaking 9.1%. CME's FedWatch has a 76 chance for 75 BPS right now. I know that was kind of starkly different from prior when we last spoke. There's a much higher chance for a 100 BPS hike. So how are you feeling right now? Sven, how are you feeling right now about, the 75% chance for a 75 BPS hike?
Well, I think that's pretty much locked in. I mean, the scare on 100 basis points was immediately whistled back by several Fed speakers. As you know, prior to Fed quiet periods, we have them speaking multiple times a day, trying to manage expectations. And I think they got scared a little bit by 100 basis points as well. I think the real big important piece here is the bond market, the yields, and specifically, we saw a run towards 3.5% in June. As you know, back then it was also high correction time in bear markets in the S&P, and everything else was falling apart. The market is already sending us a message, a larger message here, and I think we just need to be all aware of. There's no way, no how the Fed can raise rates to a 3.5, 3.8, or 4% effective Fed funds rate without bringing about a major recession. The debt construct will not allow us. We're about 125% debt to GDP now. The market already confirmed that as the 10-year was going to 3.5%, which was above the 2018 highs in October of 3.2%. Back then, too, the market screamed. The 10-year reversed. The Fed at that time, as you may recall, in October 2018, was still on their mission of quantitative tightening, being on autopilot and setting expectations for 4 rate hikes in 2019. The 10-year then already reversed. It reversed as markets corrected deep into December. And that was a signal back then. There was a signal that was also ignored by the banks initially because Goldman, JP Morgan, these type of banks had also still 4 rate hikes penciled in as late as December of 2018. So the bond market back then had it right. And guess what? The Fed flip-flopped. What we're seeing now is interesting in this context because the 10-year temporarily got above that 2018 level. And remember, back then, we had $9 trillion less debt. We've added so much debt, COVID and everything else, in the past few years. It is a natural barrier in terms of, in my view, how far the Fed can go without breaking anything. So that the 10-year has now reversed and markets have rallied as a result of that reversal, which was a big relief to markets. It sends a signal. And if you look at the 10-year, you can even make the case for some sort of topping pattern, which is completely unconfirmed. But it's reversed dramatically. And that signals something. It's maybe signals what we saw in 2018, that, again, the market is leading the Fed. And it's telling the Fed that maybe from a market perspective, which now seems completely unfathomable, but it was back then, too, in 2018, that maybe from a market perspective, the tightening cycle, which may sound radical, is already over, and the Fed will be forced to pause at some point. Yeah, they're still going to do 75 basis points now, and maybe, depending on how inflation data comes out in August and September, they may, and this may be a policy mistake, they may want to pause at some point before the midterms. Speculative on my part, but it's all part of this big equity equation that we're dealing with right now.
Beautiful, thank you. And kind of on that note, Darius, I'm curious to your thoughts as well. How do you feel about Sven's response? Do you agree? Anything you conflict with there?
No, I mean, I would say, yeah, I don't think this Fed is able to pause just politically for a variety of reasons, not the least of which is sort of consumer sentiment surrounding inflation. and also just sort of the frameworks that they've outlined with respect to the labor market. I mean, if you look at our analysis on the labor market, which is not particularly rocket science, it's just the labor market is growing at a very aggressive rate. And so if you think about the Fed, think of this through the lens of the Fed's mandate, not through the lens of an investor, which is what we're all spending time doing on FinTwit. The Fed has three mandates. It's the labor market stability, it's price stability, and it's financial market stability. And two of those things are telling them that they should absolutely be hiking very aggressively. Now, the sort of 100 millionaire that is Jerome Powell, who spent his life in the buy side, understands that markets are forward looking. But I still think there's a job to do in terms of managing expectations and not letting the inflation genie out of the bottle with respect to term premia, structural inflation expectations, et cetera.
So would you say then, from your perspective, that there should be a more aggressive hike, or do you think 75 is enough for the time being?
If I was running the Fed right now, I'd punt the economy into something that looks like a deep recession now, so that I can pivot sooner and reflate later. Reflate. Like, take this opportunity. The smartest thing the Fed can do, from my perspective, is take today's opportunity to completely whack inflation expectations. Like, just have a shitty summer, asset prices selling off, et cetera, and then get to September 21st and you can land the plane. Problem with sort of trying to land the plane now is that we've seen the backup in energy prices off the lows. We've seen ag prices stabilize. We've seen inflation expectations stop going down. And so the problem with where the dollar is and where all these sort of price levels are is that if they pivot too soon, you're going to be adding fuel to the fire. Maybe that's a political objective. It's just not one that has been stated prior to today, so we may have to learn more.
Beautiful, thank you. And I kind of want to pivot here to Alpha and Mr. Blonde, just since it's a perfect segue from Darius there. Numerous people, traders specifically, are asking the Fed to stop or pause rate hikes. They say the pain has already decimated the economy and poses a greater risk long term, and that we are already in a recession. Before we get to the point of recession itself, let's talk a little bit about what happens if the Fed pauses rates too early, or should they be stopping at all? Alf, what are your thoughts?
I'm going to hand the floor to Mr. Blonde Macro, from whom I can only learn. So, Mr. Blonde, you first.
Yeah,
that was beautiful. Thank you.
What a setup. Hey, so listen, I mean, look, I think the Fed should continue on the course until it's clear that inflation is on the right trajectory. I mean, we've talked about this before. This, a lot of what's happening today that might seem like a mistake, in my opinion, is a function of a mistake that was already made, which is they had the opportunity to kind of start the process of unwinding accommodation at an early and slow pace, and they didn't. And so now they have to go late and fast, and that creates more economic volatility. It obviously comes at a cost, and the cost is a sharper, more dramatic slowdown than maybe any of us would like. But at the same time, I think if you're hiking at 75 basis point clips, you need a Fed that has a steady hand. So that means kind of staying committed to the path until the job is done, which I think is something that Powell alluded to before. If getting the job done results in a pretty meaningful slowdown and or some form of recession, that's an unfortunate cost associated with the benefit of getting inflation down and back into a zone where it becomes more controllable. So I think they should hike. I think they will hike at least 75 today, and probably I think the tone and the suggestion from the Fed will be that they're going to continue to hike until inflation is where they need it to be, which is probably somewhere south of, I'll take a guess and say, south of 5% or south of 4%, but in a clear downward trajectory and one in which momentum is down for prices. And I just don't think that the economic growth and activity is the priority for them at this stage.
This is going to be so easy for me in this podcast. I just say the same of what Darius, Mr. Blonde, Joe, and all the others say, and I'm going to be safe. If I want to add something smart, I try at least, is that more than what we wish or we think the Fed should do by managing money, I learned we should try and understand what the Fed will do. because that is by far more important for asset classes and risk than what we think they should do. And I'm looking at the Federal Reserve that since the beginning of 2022 has moved from a bank with 2 mandates to a bank with one and one only mandate, which is to bring inflation down with a hammer, if necessary. So that hasn't changed. And they're looking at both the momentum of inflation and the composition of inflationary pressures developing the wrong way. So we have a broadening in inflationary pressures and we have the momentum of inflation accelerating. That's the setup they're entering today. And even if inflation is one of the most lagging indicators, so in macro, you have forward-looking indicators, coincident indicators, and lagging indicators, they're basically looking in the rearview mirror by targeting inflation, but they have no alternative given their mandate and the political pressures underlying. So I have to think that today, it's probably already set in stone to be a 75 basis point hike, but what matters the most will be what Powell will tell us about the future. And especially as markets are pricing a wildly different path for Fed funds future ahead, at some point, if not today, over the next few meetings, he'll have to tell us whether he even considers slowing down the pace of hikes or is going to keep looking at the only thing he seems to be focused on, which is inflation. And at that point, it's going to be very hard for him to justify any pause or any cuts because, as Mr. Blonder Darius have highlighted before, the composition of pace of inflation is very high, and it's going to take inevitably a little bit of time before it comes back to levels that are more consistent with the Fed mandate.
Perfect. Thank you for your viewpoint there. And this kind of spins me in another direction. Joseph, in your recent blog post, The Money Still Flows, you kind of argued that traders were underestimating the Fed. What are your thoughts here on what the panel said so far? Is Powell's only focus inflation and not worrying about other mandates at the moment?
Absolutely. I think Powell has been very clear, as Elf suggested, that for now, they're going to be a one mandate bank. He said it a couple ways. One of the ways he's said it is that, so usually the Fed is a full employment and price stability bank. Now, he has said that full employment is contingent on price stability. So you got to get price stability down first. He's also said that his commitment to price stability is unconditional. Now, unconditional in central bank speak is super, super powerful. It means no matter what happens, recession or not, we're going to get inflation under control. And if you listen to some recent Fed governors speak, they're actually pretty unequivocal. Governor Waller recently in his speech addressed one of the common, I think, counterpoints to this inflation in that it's supply driven. Governor Waller says our mandate is price stability, not price stability conditional on whether or not it's a supply shock. So it's actually, from the Fed's perspective, what I see, it's actually super clear what they will do. They said they're going to hike rates, and they're not going to stop until they see clear and compelling evidence that CPI is coming down over a period of months. And we just don't have a lot of time to see that. And it's not even clear that CPI has peaked yet. We have tailwinds in owner equivalent rent that'll be pushing inflation higher in the next few months. So for the Fed, they're very concerned about us moving into what they think of as a high inflation regime, where once you enter it, it's really hard to get out. This is not just what the Fed is saying. This is what the community of central bankers have been saying very loudly. And the market seems to think that this is the same playbook that we've had in the post-GFC world, where we were suffering. We were in a low demand world and inflation was very low. And whenever something happened, the Fed would cut rates by the dip, cut rates by the dip. But I think things are fundamentally changed. Inflation is high. Fed's reaction function has changed, and the market doesn't seem to in my view, has grasped that yet. So I suspect that we will have some repricing of that forward curve today.
Beautiful. Thank you. I'm going to spin this over to you now, Christian. In your perspective, is the Fed too aggressive given what everyone else has said so far? Or do you think that, from a trader's perspective, equities need a break from quantitative tightening and hikes?
Yeah, I think I think they've got a tough job, and they're kind of backed themselves into this corner. But I think that they're going to be they're going to continue to do what they're doing until we see some results from inflation. And I like what was just said. We got the CPI report that came out a couple of weeks ago was a very high report, and came in higher than expected. So they're going to be. I think they're going to continue to do what they say that they're going to do, what they need to do, with an eye on employment. But don't forget, on Friday we get another gauge of inflation, and they've said before that they do look very closely at this PCE deflator, which comes out on Friday. So, not to say that we're going to get a complete turnaround, but I think that they're going to my guess is that he's going to leave the door open in terms of just feeling out the data and saying, hey, we can kind of begin to go the other way in terms of less tightening if the data warrants it. So we'll get that data point on Friday, but I don't think he's going to really change his tune from what we heard, because we just haven't seen it in the data yet. And the employment data, while we're hearing a lot from different companies that are reporting earnings or making announcements about job freezes and so forth, that hasn't really showed up in the data too much. So I think they're just going to, continue to talk about what they need to do in terms of inflation, but they're going to try to walk the line and communicate that they're going to be watching employment data to see if anything really changes with the economy in terms of the data that comes out.
Beautiful, thank you. I'm gonna spin this to you now, Brad. Same question, but kind of in regards to growth. How do you feel about what they said so far?
Yeah, it's hard to disagree with anything that's been said. So I'll really just add and try to create some or make some different points so that we're not all just agreeing with each other for a few hours. But so two mandates. It's been talked about a lot. And when you look at the labor force and a 3.6% unemployment rate, it's got to seem like the Federal Reserve is willing to concede a 4%, a 4.5% unemployment rate. Even if we peak at an 8+% CPI, and it was just very rightfully stated that things like rent inflation and wage inflation, which are very sticky parts of the CPI, are not going to go away as quickly as commodity inflation. But I mean, when we're dealing with when we're dealing with these two mandates of employment and inflation, and when we have two people or two job openings for every one job seeker, and when we have this very sticky part of the CPI, which is wage inflation, the Federal Reserve has to lean in and they have to tame inflation. And yes, we can peak at 9% and a 9% CPI, or hopefully we do, because we're seeing things like wholesale gas prices and commodities fall. But if we stubbornly stay at that 5 or 6% rate, even if we stay at 4%, I mean, we're not going to be able to just kind of pivot and pause and cut rates and get back to what was just stated in that really buy the dip mentality. And I mean, we've changed a lot. And I'm a long duration growth asset investor, and I'm keeping a very large cash position right now, fully in anticipation of the fact that inflation is the only thing that matters right now, which has been rightfully stated. Because although we're getting layoff news from TikTok and from Coinbase and all these companies, we still have an extremely tight labor market. And that is still contributing to an extremely sticky piece of the CPI, which is wage inflation, which is running way above sustainable levels, which I'm sounding a little insensitive right now, because I'm saying, okay, let's hike into inflation. Let's get rid of wage inflation and make people earn less. And it's just a really unfortunate, reality of economic and macro cycles where we do. I mean, a soft landing, yes, I suppose it's always possible. Every single Fed chief will try to convince us that it's possible, but it's extremely hard to do if you want to look at history books and our most recent hiking cycles, which is where I have to learn because I'm 25 and haven't lived through this yet. But I mean, they really can't pause, they can't slow down until, in my opinion, we have a very meaningfully falling and precipitously and consistently falling CPI. And Darius, it's great to meet you. What you said about kind of front loading rate hikes, I wholeheartely agree with. Just getting to that point where just accepting the fact that we're soft landing is like a unicorn. And if we want to get to that point where we can pivot and hike a little bit less aggressively and get to that point where long duration cash flows are being discounted at a less aggressive rate, we probably do have to get to a point of pain and a point of recession. Just looking at all of the all of the last hiking cycles and where that really ended up. And really, I think we're sort of kind of starting to get there. And I hope we're trying to get there because, I mean, if you look at asset markets, we've given back a lot. But I don't love the 10-year, 2-year yield curve. I think that's kind of noisy. But if you look at the 10-year, 3-month yield curve, that's been racing towards inversion. And looking at 2018, looking at the Great Financial Crisis, the dot-com bubble, Black Monday in 1987, those are the last inversions we've had there. So to me, that's the sign that I'm looking at in terms of yield curves and what to watch for in terms of when we do get to that recession, when we do go too far, and when we can kind of pivot and turn around, and when I can selfishly lean in and invest a lot of this cash position I have sitting on the sidelines in these wonderful companies like Trade Desk and CrowdStrike, which are killing it, but no one really cares right now, and rightfully so, because we're in this very aggressive hawkish cycle, and because these are long duration assets, and because they're being discounted far more heavily. So I don't know if that was a little bit of a tangent. It probably was, because I have a hard time keeping my thoughts quick and brief. But I'll pass it back to you for now.
No, actually, you gave me a perfect segue. I was just going to thank you for that. But before I segue, everybody listening right now, we've got quite a few people in here now. If you're not following the folks up here on this panel, please do so now. By not doing so, you're missing out on a lot of free information these folks are dishing out. Really brilliant people. And again, ridiculously grateful that they're all here to speak for you guys. But kind of back to that segue, you had kind of a comment in there about layoffs. Darius and Mr. Blonde have both spoken at length with regards to recessions. And Darius, since you recently said the following, I'll probably pitch this to you first. You recently said lots of weakness was priced in at the lows, but your research is definitive in suggesting that an actual recession has not been priced in. Can you kind of touch on that a little bit?
Yeah, happy to. So there's 6 sets of market indicators that we look at to confirm whether or not a recession has been priced in. We look at everything, obviously, but just as it relates to recession, the financial conditions index, the S&P 500's next 12 months earnings yield, IG credit spreads, the ratio between defensive stocks and cyclical stocks, the ratio between high beta stocks and low beta stocks, and then finally VIX curve, the slope of the VIX curve, or whether or not it's in backwardation. And at the recent lows in the market last month, we were very shy, particularly for the indicators that are spread based, very shy of levels we reached in, kind of even in the mildest recession in U.S. history, which would have been 2001, well shy of what we saw in 1990, 1991, and obviously well shy of what we saw in 2008. Same goes with the high beta, low beta ratio between cyclicals and defensives. And then even if you got the VIX curve backwardation, we didn't see the kind of capitulation you typically see at the bottom of a bear market. Not even a bear market, but just even like a significant correction of substance, going back the last kind of 15, 20 years. So, when you look at it through those lens, I know the market was down 24% on its lows, but, just from an internals perspective, from a cross asset perspective, and ultimately from a liquidity cycle perspective, it's very unlikely that the market has actually gotten to come to grips with a real recession, with a hashtag actual recession.
No, it's not 2 quarters anymore.
I made that distinction as well. Just really quick thing on that. So I'm sure there's some folks on the call or on the spaces that are sort of a little bit confused what I mean by that. So there's a technical recession, which means the GDP is contracting on an annualized basis 2 quarters in a row. There's a lot of reasons why GDP could contract, including big swings in inventories, big swings in the trade balance, which generally don't tell you much about kind of the underlying health of the economy. And then there's the hashtag actual recession, which the NBR defines as a kind of multi-month period of a significant decline in output and income. That's kind of spanning across all sectors of the economy, and we very much we have not seen anything that looks like that. We're starting to see some leading survey data. You look at the PMIs, the consumer confidence measures, some of these regional Fed measures that kind of starting to look like that. But generally speaking, we have not even come close to and realizing that.
Mr. Blonde, do you have anything to add to that? I'm really curious about your thoughts in regards to technical and actual recession.
Yeah, I don't have a lot to add. But I would echo a lot of what Darius said. I guess I take it from a slightly different angle. If S&P was down 25% peak to trough into mid-June, if you look at historical recessions or drawdowns that occurred around recessions, particularly if I look at periods that had an inflation-like component to their, in the backdrop, 87, 74, 2008, and and we maybe even want to include 2001 style, recession given the valuation starting point. But all of those periods pretty consistently had a drawdown that was more like 35 to 40% in markets, and so that rule of thumb would tell you we certainly have considered the recession outcome, but haven't fully priced it in, as Darius said. The other factor I would point to is that you can have an earnings recession and not have an economic recession, but you can definitely not have an economic recession and not have an earnings recession. And an earnings recession, you're going to see EPS drawdown somewhere in the neighborhood of 15 to 20%. And even if you put a higher multiple on that, I don't think that we're yet priced for an earnings environment that has kind of sub $200 on S&P 500. The current forecast for 2023 is, I think, 238 and falling. So those two things don't make me think that we've had a recession. But look, I mean, markets don't move in a straight line. And I think at this point in the cycle, the fundamental aspect of weakness is the part that sort of tends to move a little bit more slowly, in that liquidity corrections, valuation corrections happen quickly. And in my judgment, that was pretty much the January through April, January through May period. And now we're sort of dealing with something that's likely to be a little bit more slow moving, and that the fundamental weakness or the sort of the probability or the risk of recession probability happens over the course of a couple quarters. The earnings downgrade cycle is something that happens over a couple quarters. Markets can certainly move faster, but the realization of that is something that moves with at a different speed limit than Fed hikes, removal of liquidity, and valuation corrections.
Beautiful, thank you. And now, kind of same question to the whole panel, honestly, and answer. Pitch it to Sven. Are we in a recession now, currently?
Not until midterms are over. No,
Sven,
I'm kidding. And I'm going to try not to just agree with everything that's being said by the panel, but what Darius had to say about technical recession in terms of earnings growth and an economic recession, I think is spot on and doesn't need much more context from me.
Unlike Mr. Bullard, I do believe the yield curve is signaling a recession coming, especially if they keep hiking aggressively. Look, here's a couple of things maybe I disagree with what was said earlier, at least on the maybe belief in terms of how much credit to give the Fed what they actually say. Their job is jaw boning, and frankly, I think the mission from the beginning of the year for them has been to let the market do most of the tightening in the hope that the reversal in asset prices will bring about a slowing in growth. Check, it has. And that will ultimately bring down inflation. They don't want an event. They don't want something to happen from a systemic perspective. And so I'll bring back the extreme high debt levels that we have now. And note that the decline, as vicious as it may have been, or as deep as it may have been so far this year, has been extremely orderly. And from a technical perspective, even I would argue, predictable. And so keep in mind history here, and that's really important as well. The Fed tends to hike rates until something breaks, right? That's why we tend to enter recessions on the rate hike cycles. The only exception really was 2018 when they pivoted before. And so the unknown for us here in terms of this setup here is obviously this massive inflation that we have. Some of it is completely out of the Fed's control. And the examples that we have in terms of high inflation was 1974, 1980, 1982. Then, too, they ended up cutting rates, not because inflation was solved. No, it's because recessions occurred as a result of the rate hikes, and inflation was then starting to roll over inside of the recession. So you'd be surprised maybe to hear that they cut rates in each of those events with CPI still above 10%. So I would argue they knew from the very beginning of the year that they had to bring about a recession to get inflation under control. Not rate hikes. It's about getting a recession to slow things down to that point. Politically, they can't say that, and that's why they will avoid recession talk and definition moving whatever to the very last moment when they have to admit that. Because if they were to admit that we're in a recession or that we're heading into recession, it's going to be really difficult for them to justify further rate hikes. And of course, the labor market is right now maybe the lagging indicator here, in the sense that it gives them an excuse to continue on the rate hike path. But make no mistake, an organization that spent 15 years of managing the economy via asset price direction and spent a fortune on it, right, in vis-a-vis QE and zero rates. And even last year, we're keen to really be slow on any tapering talk for fear of creating another taper tantrum. They're not going to suddenly completely ignore the asset price equation issue. So they will literally find any excuse, in my mind, that if there is a reason for a pause, they will find it. It does not appear in their official language at all. But we've seen this time and time again. Their official language, at the end of the day, is not predictive of what they're actually going to do. And I think this is a comment I support what Alf said earlier. But we shouldn't focus on what they should do, but rather what they will do. So this DNA of the Fed that we've seen time and time again, they cannot be blind to the risks they're facing with aggressive rate hikes into this hyper-valued market from last year that is still historically very highly valued. So they are, I think, from my perspective, watching this all very carefully, and they don't want to see a systemic event. And that's, so far we haven't, that's the good news. But yeah, we again, I come back what the bond market is signaling, and as I said earlier on Twitter, when in doubt, believe the bond market. And the bond market obviously has set a fairly significant signal in the last month. I'll leave it at that.
Beautiful. I love to see some differing viewpoints. They make it really easy to get some good back and forth commentary. So I'm going to pitch this to Alf. After what Sven said, is there anything that you would change about what's been discussed so far? Do you agree with everything Sven said?
I would just point out to a piece of analysis I've carried on over the last week or so. There's nothing to be happy about the recession, but at least it seems to be one of the most convincing ways to slow inflation down. And obviously, if you are the Federal Reserve or a policymaker in the US, you don't want to engineer a recession. You do soft landing. But history says that over the last 100 years in the US, every time you enter the recession and inflation was above 3%, basically us today, every single recession, 11 out of 11, they've been able to slow significantly inflation down to the tune of 7 percentage points from peak to trough on average. And it took on average 15 months to slow inflation down from the peak back to 2%, which is the Fed target. So as you enter, assuming you enter some sort of a recession, not only the technical one, but also the consistent one backed up by labor market weakness, and assume you enter that round about now, history would tell you that in 16 months from now, on average, you would see inflation back from 9% all the way to 2%. So recession might not be what policymakers are looking for, but it might be one of the few convincing things from a historical perspective that is able to slow down inflation pretty consistently. Just wanted to add this piece of research I've carried on over the last week or so.
So I'm going to open this to the panel once again on the idea of recession and hikes. And if anyone wants to comment on what's been said so far, that's fine. I just want to open this up to the panel. So anybody else have any comments on that?
I'll make a note. Yeah, I'll just make a quick note about the level of debt constraining how much the Fed can hike. Well, first of all, I'm actually surprised that we got this far into a hiking cycle without really there being any accidents. To recall, back in 2018, we were a little bit below this level, and it seemed like the equity market just imploded. So I think we should not just look at the level of debt in the system, though, because debt is just one side of the equation. Assets are the other side. And household net worth is at all-time highs. It's exploded higher. If you think about what everyone owns, 60% of Americans own a home. Well, that's up 30%. S&P 500, still 20, 30% above pre-COVID levels. So even though the level of debt in the system is higher, the level of assets is also much higher as well. Now, Powell obviously has a reputation of being very scared of the markets and being careful of not to prick the bubble, so to speak. And I actually think that history is part of the reason why he would try to be more aggressive this time, because I think he realizes that he kept policy too easy during the COVID times. He should not have kept buying mortgage-backed securities, for example, when the house prices were already up 20% year over year. And that's going to force him to overcompensate a bit to show that he's just not a pushover. And, he's also been very wrong about transitory inflation. So he's going to have to, at least politically, try to compensate for that.
I would not disagree with that. I would just say, there's a concern that the Fed is making policy based on what they think their credibility is, or not to lose or save face, basically, vis-a-vis previous mistakes. And there you get into a very dangerous territory, because that's the risk of the big policy mistake here, right? Mohammed El-Arian won about this last year, about them being too loose, too long, and then forced to slam the foot on the brake. And then something does break. None of us can predict what might break, and so far we are fortunate that nothing has broken. But in general, Fed psychology here is a concern, and it's a concern that they're again maybe then too slow to react to what the market is already signaling to them. And they were terrible on this last year. They were too slow this year, and obviously now we're getting to a point where they are locking themselves again into a narrative from which, the narrative right now, there's no recession, it's not their base case, blah, blah, blah. And we have positive GDP growth forecast into next year and beyond without any recession. And so the narrative is the danger, in the sense that the Fed itself, again, is more concerned about their image as opposed to what the right policy is, or the danger of whatever policy is that they're currently locking themselves into it. So I just throw that out there.
I have a quick question. This is for Joseph. I mean, based on what you just said, I mean, you suggested that you're surprised that we haven't seen anything break yet in the context of this tightening cycle. I guess I have a different perspective. I mean, I think that this tightening cycle, sort of at least on the part of the Fed, only really started in March, and it's been a very sharp, fast cycle. So in terms of time, I'm not sure that we've had enough time for that, the tightening cycle to manifest and show up somewhere, or whatever is going to break, to sort of show up in a tangible way. So that's one thing. I think the other thing is on household net worth. I mean, I'd be careful about those, the stats that are old, right? I mean, so since then, equity markets are down 30%, on an all cap basis. I think there's pretty clear signs of activity slowing in the housing market, and usually that precedes a price slowdown, and maybe that price slowdown is not as dramatic at the national level as it is in some pockets. But then there's another big part of household wealth, which is fixed income, whether it be muni bonds or otherwise, that's down in price. So I'm not so sure that this. I guess this kind of falls under the category of policy tightening works with long and variable lags, and maybe just because we haven't seen anything yet doesn't necessarily preclude us from seeing it in the near future.
I think of the tightening cycle being short and aggressive as more likely to break something, and that, in my view, is more stressful because the market has less time to react. So I am surprised, because the last time, we saw the equity market tank in Q4 of 2018, but it seems to be much more orderly now. And of course, the market learns, so probably should not expect it to react the same way. Now, I agree with you completely that net worth has come down a bit since the beginning of the year. But if you just look at the pre-COVID levels as a benchmark, it's still up a lot. And as the market seems to think that the Fed is going to cut rates next year, it seems like it's rekindling some risk sentiment. So, bond prices are going higher again. We're getting a bit in major equity indices. Even if you look at crypto, I mean, we've come down, Bitcoin has come down a lot from 60,000 to, let's say, 25,000. But if you think where it was pre-COVID, it's more than twice as high as it is pre-COVID. So just over a couple years, people do have a lot more wealth. Not as much as they did earlier in the year, but I think sizably more than they did pre-COVID.
Well, they also have less real wealth, though. Agree or disagree?
What's real wealth?
Well, like inflation adjusted. So we talk about these numbers of wealth in nominal terms or spending in nominal terms, or, excess, household excess savings in nominal terms. But a lot of that is naturally eaten up by the cost of essentials.
Yeah, Mr. Blond, to your point, savings levels, I think, are setting like decade levels or maybe even more. So we got that massive spike from stimulus, and then it is completely normalized and then some.
Yeah, savings, that's a flow variable. The stock is actually much higher than it is before. No, I agree with you, though, Mr. Blond, that inflation, that does erode a lot of the gleans. I haven't done the math to see how much real wealth we have. I would be surprised if it's less than pre-COVID, though.
I have to chime in really quickly and say this is a wonderful conversation and just having a lot of fun. And then one more thing I wanted to add. So this point of not breaking anything, there are probably a lot of equity investors like me listening to that and saying, well, didn't equity markets break? And I think in the context of the Federal Reserve, it's really important to consider that they don't really care about equity markets. And again, I'm a long-term investor, and I'm saying that they do not care about my stocks. They really care about credit markets and the massive relative impact that has versus equity markets. And when you're looking at things like ICE, Bank of America, U.S. high yield index option adjusted spreads, they have spiked out a lot, which getting towards breaking, but they're still way below where we've been in terms of taper tantrum, in terms of all of these other exogenous macro events that we've had that have really put stress on the system. So just wanted to say, agree that nothing is broken. And I am a little bit somewhat surprised that these spreads aren't higher. And then also just want to give the point that I do think there's an artificial cap, just going off of, Joseph, what you said about debt to GDP ratio being way higher than it was when someone like Volcker was hiking rates as aggressively as he was. We don't have the room to do that. We can't afford the interest payments. And I think that puts kind of an unfortunate, for some people, but fortunate for me, artificial cap on where the Fed funds rate can go. Now, where that is, I think other speakers on here have a better idea of that than I do, but just wanted to give those 2 points. And then also just mention that this conversation has been awesome and really happy to be part of it.
Yeah, I'm on my Bloomberg now, so I just did the math on the net worth thing, Joseph and Mr. Bond were discussing. So net worth since the end of 2019 is up 28%. If you inflation adjust that, it's up 14%. So it's a pretty significant rise regardless, but obviously inflation has eroded a lot of that.
Yeah, and what number would that be if you actually use the real inflation number and not the fake ones that the government puts out?
Are you trusting the net worth statistics as well? They're all government statistics. Who cares? It's apples to apples.
So since that gave me a new segue, I'm just going to pivot to Joseph. Do you have any thoughts on that?
I don't know. Thanks for doing the math. That was really helpful. So I guess net worth adjusting by government numbers is sizable, but not as high as nominal. I'll actually make a point about not being able to hedge funds because we have a lot of debt. I hear that a lot, but it doesn't really make sense to me, because if you're on a fiat system, you can always afford your interest rate payments. There's really no limit to that. At the end of the day, you could always have the Fed buy it, which is what the Fed has been doing, for the past 10 years. So the sovereign debt levels are not a constraint to any fiat system at all.
Joseph, this is a very smart remark. I'd like to back it up by saying that the higher likelihood of having a financial crisis of any sorts in a fully elastic fiat system stems from very high level of private indebtedness. households and corporates cannot print money to repay their liabilities or service their debt. They need earnings and cash flows. And if the structural drivers of economic growth in the private sectors are weakening, labor force growth, productivity of capital and labor, these aren't strong enough, and levels of private debt are increasing, that often becomes the real underlying problem, much more than government debt, which is covered disproportionately more in mainstream media, I think.
And I think, Elf, you've done some really good work on showing some zombie companies too that might have trouble refinancing some of their debt if rates go higher. So that's definitely something to think about.
So since we're talking about blow-ups, I'm going to open this to the entire panel. So anybody feel free to chime in. Feel free to yell at each other if you disagree. Let's get some violence and energy in here, guys. So open to the panel. Since we're talking about blow-ups, is a Federal Reserve blow-up coming given macro environments?
I think we're much more likely to see a European central bank blow up before a federal. I mean, you see what's going on with their crazy situation where at the same time they're trying to raise rates, but at the same time they're stuck with trying to support the peripheral, the basket case countries like Greece, Spain, Portugal, and Italy that are just not even remotely competitive when being in the same currency with, Germany. The European Central Bank is in way more trouble than the Federal Reserve, and my opinion.
Yeah, good point from Wall Street Silver.
You look at the Bank of Japan, and they're the biggest basket case of them all. They're starting to lose control of their currency. They're starting to lose control of their bond market. They're a big owner of their stock market. Decades and decades of this sort of monetary policy has delivered no relief from the real estate crisis and the sort of economic slack it left in its wake. And there's also demographic issues that are compounding it. In some ways, we can look at Japan as a bit of a preview, even though there's a lot of differences. We can at least say that, the law of diminishing returns are in full effect. And there's a certain point where monetary policy and fiscal policy just don't really do much more than push on a string.
Central banks can't blow up. They print money.
Yeah, I think didn't Greenspan have the comment that we can guarantee all of our payments, we just can't guarantee the buying power of those payments. I mean, they'll print whatever the heck they have to. They're never going to default. It's just you can't guarantee the purchasing power of what they're actually throwing out there in the system.
Fair to say, though, that when you enjoy the world's reserve currency, you have exorbitant privilege. I don't know that we can say that about every central bank.
You can probably say that the big ones. I mean, that's more of a developed economy central bank situation as opposed to just the world reserve currency. All the developed economy central banks, can issue debt in their own currencies. It's the developing world that doesn't really have the privilege of issuing debt, being able to raise capital within their own currencies.
I mean, they can't actually. I mean, technically, they're not like the Fed. They can't just force the ECB to buy their debt. So it is possible for big European peripheral countries to have debt problems, but that would be more of a political, self-imposed problem that they have.
Well, I mean, that hasn't really been a problem so far because the European Central Bank isn't willing to let any of the European countries fail. And whether that's a smart economic decision or not, that's another discussion. It's more of a political thing in that the powers that be in Europe are not willing to let Greece or Spain or Portugal or Italy or Ireland or any of those countries that really have had, are on the verge of, Ireland, some of them have grown out of those problems, but the European Central Bank's not going to let any of them fail, and that's more of a political decision than an economic one. I think Alf would probably agree with that. I know that's one of his opinions.
And that's the segue I was looking for, baby. Since we're talking about the ECB, given I believe their first ever 50 BPS rate hike and their anti-fragmentation policies, is the ECB doomed, Alf?
I think both the comments from Wall Street Silver and Joseph are very valid here. You can see that in sign price action already. While the ECBs will be doing their best to try and backstop sovereign countries, because that is Well, the first point where the weakness actually arises, right? This is the most liquid market. Like, for example, Italian government bond market. You can short them very, very easily via futures. They are subject to, very, very quick and fast drawdowns from speculative investors. And they always are very important for the transmission mechanism of the central bank. So they'll try to make sure that those don't blow up. And you can see that the instruments they're designing are, well, somehow achieving a mediocre result so far, but a very good one if you compare those credit spreads against corners of the European market where they cannot directly intervene. If you look at the CDS on high-yield European debt, for example, it's blowing through the roof. And why? Because the ECB does not have a direct mandate to actually backstop some high-yield junk corporate issuing debt in Europe, while they have an inherent mandate, you can assume, which is what Wall Street is trying to point out, and I agree with him, to effectively backstop the very existence of the overall project. And ultimately, it can take a little bit longer, especially because of the fragmentation that Joseph was discussing before. If you remember, the German Constitutional Court has approved quantitative easing programs to be legal under German constitution only because they were designed to have a certain defined size and a certain defined timeline. So let's say yield curve control or perennial QE sort of programs are deemed not to be necessarily legal under German constitutional law. And obviously all these, bureaucratic aspects, all these fragmentations, all this weird architecture Europe has, puts them in a quite awkward situation compared to the US or even to Japan, where there is one fiscal policy, one monetary policy, and it's much easier to harmonize them together. In Europe, that is really not the case.
And I don't even know if the German courts have yet. I mean, this whole new anti-fragmentation tool that the European Central Bank has come up with, it might not even survive the court system, because I don't know if that's going to be allowed, where the European Central Bank's able to favor specific countries and just arbitrarily put Germany and the Netherlands on the hook to pay for it all. I don't know if that's been decided yet, I know it hasn't been decided yet, and I don't know if anyone's going to have the courage to actually challenge it, but I know the German court system has had problems with that type of favoritism in the past.
Christian, I'm wondering if you had any comments on Europe's perspective thus far in contrast to American markets.
Oh, geez, that's a great question. I view Europe as kind of the and I hate to, and I'm not trying to offend anyone, but just a little bit of a canary in the coal mine. They seem to be more sensitive to to moves. They really haven't had any major rate hikes. Until just recently, where Lagarde made the announcement. But I think that Europe could blink first or could pivot first. That's my take. We've certainly seen over the years certain things. We've heard about Brexit and whether or not these things were really going to affect the market, and they ended up not so much. But my job is not really to kind of predict if there's going to be any major danger there, but just to basically watch for things unfold, and whether or not these things are going to be more talk of major issues, or if they're actually going to be real issues. So I think they will be important to watch, because it seems like they've got, believe it or not, more issues than in the US, and they could be that canary in the coal mine to say, wow, something's really not working there, and something's backfiring there, and they're going to really have to kind of move away from that hawkish tone and address some of their issues.
Well, the key is going to be the Italian election that's coming up. Mario Draghi's on his way out, and the next government, is it going to be a spending government that just totally ignores European rules, and is, historically Europe just has a passion for kicking the can down the road and not really reforming and fixing problems in their banking system. And look at Italy's like 25% of sovereign debt in the entire Eurozone, isn't it? Something like that. That has a real you thought the Greek debt problem was big. That was tiny compared to what's going on with Italy. If Italy really, the spreads between Italian debt and German debt, if they get huge again, That's it. That just could just spiral out of control so badly if the European Central Bank's not able to make this anti-fragmentation rule work. And if you look at the actual rules for the anti-fragmentation tool, I forget the acronym. What is it? I forget it. But they want to raise rates but keep buying Italian debt, basically. And if you look at the rules they issued, Italy doesn't even qualify for them to be able to buy the debt, for the central bank to buy the debt. So I don't know what this new government, we won't know about this new government. It's going to be up in the air for months still to find out who the new government is and whether they're going to play ball and follow the financial rules. And historically, they haven't followed the rules. And historically, the European Central Bank doesn't enforce the rules. They just sort of, we're not going to let them fail. We'll just ignore the rules and buy the debt anyways, right?
Tracy, are you here?
Yes.
There we go. Perfect. I'm going to pitch to you here, since we're kind of talking about this global macro view on things. Speaking on that macro environment, could you kind of give us a quick overview on what you're seeing given the Ukraine and Russian war right now in oil?
Although we've seen obviously a pullback in prices across energy and metals, what we're seeing is, we still have a structural supply deficit across the entire, base industrial and energy sector. So the markets are extremely tight right now, even though we've seen this, almost 30% pullback, especially in the metals right now. Moving forward, I think that the Fed is going to have a very large problem trying to solve a supply side deficit by raising rates. I mean, I understand that they're going to try to destroy demand, but because of the enormity of the deficit, I think that it would be next to impossible to completely move the needle really on the demand side, because we're really not seeing any kind of demand destruction right now, and prices are sky high. We haven't even seen China come back to the market yet, right? We have the People's Party Congress at the end of October. He is not going to want to have his whole country locked down at that point for his quote unquote election. So, we have that coming into the market. So I think we're still set to see higher commodity prices despite all of these rate hikes, even though I know that we're seeing signs of slowing, say, in the housing market, and that will affect the commodities market in general. But globally, we're just not seeing it.
So, Tracy, the Biden administration is still dumping all sorts of oil out of the Strategic Petroleum Reserve, and that's got to end, obviously. That's sort of a short-term sugar high.
Exactly.
How much lower do you think how is that a big deal? 20 million here, 20 million
yeah,
there,
obviously,
but that ends, right? That ends at some point, right?
Yes, we hit the bottom of the barrel, so to speak, at some point. So yes, 200 million barrels is a big deal. And the thing that I keep trying to express is that fact that we have high gasoline prices right now, yes, but we are not in a crisis. We are not near where Europe is right now. The problem is going to come when we are in that sort of crisis, and we do have gas lines, and we do have gas rationing, and we don't have a reserve anymore because we drained it all for no reason. And that's kind of my argument against that. The strategic reserve was built in the 1970s due to the oil crisis, the Iran oil embargo, and that was so that we would never be in that position again. And so to drain it right now for no reason except for high gas prices, which is not a crisis, that puts us in a very vulnerable position moving forward when we are looking at an energy crisis in Europe, which could very well spread to the United States.
Yeah, I saw someone tweeted out that they should just change the name. It's no longer the Strategic Petroleum Reserve. Now it's just the Petroleum Reserve. There's nothing about it.
Exactly.
So given that backdrop of Europe versus the States, I'm gonna pitch it to Aisha here next. Thanks for joining us. So given this backdrop of Europe versus America and the geez, I cannot speak, y'all. Given the structural supply side problems at the moment, what are you seeing?
Thanks for having me on. No, look, I'm with Tracy on this. I think, we haven't seen peak demand as yet. Uh, we were just on another show a little while ago, and we were just talking about this, and, she says it right. I mean, we haven't seen China come back as yet at all. And we were looking, so my estimate for next year was about 100 million barrels, but now I'm seeing people are saying that it should be at about 130 million barrels. And this is a big difference. Now, in terms of oil production in the Middle East, something else I was saying earlier as well is that, and I am from the Middle East, right? So we do have enough oil to pump right now. Although most people say that we don't, but we have our strategic reserves as well in the ground and otherwise. But the way our budgets are, they're keyed off a certain price, and we'd love to see oil above $100 a barrel any day of the week, because this gives us surplus to reinvest and do various other things, and in fact support the economies here, because we are oil-driven economies. And the other thing I was saying is, the OPEC is a cartel, and they will always behave like a cartel. So regardless of whether you are asking them for oil or you're not asking them for oil, they will do what they have to do, because it's more important for them to support the economies versus supporting the whole world. And in fact, I do think that we will see higher oil prices for longer, just as Tracy said.
Sven, do you have any comments there? I figured you might have something to say.
I do. Sorry, I was chewing.
You're fine.
I tried to sneak in a dinner before the Fed announcement. I actually wanted to say something about the ECB briefly, because this is actually impacting all of us, and that is the impact on the relativity and the central bank expectations. That's why we had that dollar spike for a while, because the ECB was so terribly slow and lagging. I'm just putting up the main dollar chart on my Twitter feed real quick so you can see it. And technically, it was absolutely quite beautiful, the rejection that we saw now that the ECB has joined the rate hike club, so to speak. Obviously, they're still woefully behind. The issue is Europe is a much greater risk of recession than the US, in the sense that we have this mess with energy prices, natural gas, and it's a big political problem as long as we don't have a resolution to the Ukraine-Russia situation. So to the extent that they find themselves, again, limited in following through on rate hikes, then that may put more pressure on the dollar, which would be bad for U.S. equities. At the same time, if they actually do follow through aggressively and the Fed actually slows down, that could push the dollar down quite a bit, because it's still very much overbought on a monthly basis. And so I think from an equity trading perspective, we just need to keep an eye on that as well, as it pertains to the high correlation that we have between the dollar and the S&P at this point.
So we've got the report coming out in about 2 minutes here. 2 minutes until FOMC. Anybody have any last guesses for rate hikes? Are we still thinking 75 is the target, or will we get a sneaky 100 in there?
I think 100. They need to get it up quick before we're officially in a recession.
Anybody disagree with that? I know a lot of folks have been thinking 75.
If they do 100, will it be a dovish 100 with Powell in the press conference maybe trying to taper expectations a little bit? I'm just putting that out as this question.
To me, a dovish 100 sounds like an oxymoron.
Or just a moron.
Can you expand on that a little?
Yeah, I'm just saying, under what scenario is 100 basis point hike dovish? I don't. That doesn't make a lot of sense to me. Look, I said it before.
I could see where Sven's coming from that. They do 100 and then they say we're going to pause and just sort of see how the market digests this. I mean,
I don't. Why would they do that? That doesn't make any sense. I mean, they're not in a position to kind of have that kind of foresight. Well, they didn't. They hiked 75, so it doesn't matter.
when does the Fed have any foresight? They've been hugely wrong on everything for over a decade. So I mean, who knows what they do? They're clueless.
Well, they
It
did
looks like
75.
it is 75. It looks like it is 75. So I guess we can just kind of continue this panel-wide discussion. I love this discourse so much, everyone. Thank you. What does it mean? What's the 75 mean for us? What's it mean for the markets?
At this point, it's completely priced in. It's all about Powell's press conference and his language that he will be closely judged on. So I think the market right now is just going to hang tight here until he speaks.
After seeing this, Mr. Blonde, can you take it from here? What are you thinking now?
No, I mean, I think it's pretty consistent with a lot of what we talked about. I mean, I think 75. It seems like they repeated their focus on inflation rather than giving any nod to some of the weaker growth numbers that we've seen. It was a unanimous 75, so nobody was voting for 100 or voting for 50. So they presumably agree. I think that it's pretty consistent with. Look, I agree with whoever just said. I mean, a lot will come down to the press conference and how Jay Powell mumbles through, the delivery of this. My guess is that they don't really give us a lot on forward guidance, meaning I don't think that they're going to commit to anything in particular. I think the focus is going to be we're going to continue to fight inflation until it's at a pace and level that we're comfortable with, and we're not there today. And if that means that we have to hike 75 in September, so be it. If that means we have to hike 50 in September, so be it. It sort of is, we'll decide that at the next meeting, as opposed to pre-committing to anything today, when so far their ability to forecast where we be at this point has proven to be challenged at best.
But Sven made a good point. I don't know, maybe 15 minutes ago, where a lot of the inflation we're seeing is out of the control of the Fed. And the last time Powell testified in front of the Senate, a lot of the senators were hitting him up on that too, saying, can you control oil prices? Can you control food prices? And Powell said, no, us raising rates ain't going to control things like that. And so you're already seeing the political pressure starting to build of why are we continuing to raise rates to fight inflation when what the Fed can do doesn't really have much impact on food prices and energy prices. And, I think that's what Sven was saying a little bit ago. I'll let him say it in his own words. But I think you're going to start seeing that narrative more and more from the political sphere to start pushing back against the Fed on continuing to raise rates when so much of the inflation's in regions that the Fed doesn't impact. Just my opinion.
Yeah, and look at Elizabeth Warren came out and I think she beat Powell up pretty hard last time. And where we are politically doesn't really matter. It's just observational here to say that political pressure is going to increase on the Fed. And Powell has shown himself to be listening to political pressure. We've seen that before as well in 2018, 2019. So I wouldn't put anything past anyone at this point. And I think, again, to the extent that you see a sizable relief in inflation data, which none of us can really predict, although I can say there's key rollovers in not only commodities, but, even supply chains. We're seeing a massive reduction in prices. All this will filter through. And, the data that we're seeing in June is lagging, right? So we're just going to have to wait and see how this data evolves. And we'll see how the Fed reacts to it. And of course, economic data, absolutely key. Because if this slowdown continues to accelerate into the late summer, right before the midterms, politically speaking, you're not going to get reelected with a recession, right? No, they don't want to see this. That's why we see all this recession denial right now and definitional wordsmithing and so forth. There are political agendas at play, and we cannot ignore that either.
I'm going to agree with both Sven and Silver in that there's going to be a lot of political posturing saying that the Fed can't do anything about supply, and so they should not be hiking rates. But the Fed has actually already pushed back against this idea. So, as I mentioned earlier, Governor Waller pointedly said in his recent speech that their goal was price stability, and it's not that if it's caused by supply shocks, they don't have to do anything. Their goal was price stability, period. So that's the Fed pushing back against that particular kind of narrative. And I would also remind everyone that when the Fed was hiking rates, we saw, at least in the paper markets, the commodity markets kind of basically took a dump. So it does do something. Now, I understand the paper is not the same as the physical, but they're still connected. And it did seem to have an effect on inflation, or commodity inflation at least.
How are you thinking now with the 75, Christian? What's your initial reaction?
Yeah, I mean, I think, thank you, by the way. I think what we're seeing right now in the market, there's not much market reaction because, this is exactly what the market was pricing in with 75 basis points. The Fed fund futures don't lie. That is what the bond market was pricing in. Next, I think, which was already said, is we've got 2:30, which is the Fed conference, and the press conference, which could be where we might get some new information. We'll see if, at some point in these press conferences, somebody usually has a pretty good question. And then also, we always see these whipsaw price action moves too. The first move isn't always the direction that we could, end up going by the end of the day. Because of that, press conference is actually, in my opinion, more important, considering that, the rate was exactly what the market was expecting and what the market was pricing in.
So I think what we're seeing is actually a very muted reaction. It's probably because it came out exactly as we thought. I mean, every time before this, I've seen futures, S&P futures chopping up and down, NASDAQ futures chopping up and down. But today's price reaction seems to be a little muted. But as I speak, I see it drop a little bit more. I think we'll have to wait for the press conference. I think something that I'm looking out for is whether the Fed actually acknowledges that, the consumer is now weak. We're heading into a recession. All the usual problems that we are actually seeing. I'd like to see them acknowledge some of it because all they've been saying is the consumer is extremely strong and, unemployment is extremely strong. But and while it is, we know we're moving the other way. And so some acknowledgement from Powell would be nice, and perhaps somebody out there will ask the question. So let's see how he reacts to that. And I always love these press conferences. They're really, really good.
Given the 75 BPS hike, just a few months ago, the general consensus was that 75 would never happen. Here we've had it a couple times. Does that kind of lower your faith in the Fed? Is that something that we should be concerned about? Given, I think just 2 months ago, actually, Jay Powell said, no 75 BPS hike, it's not going to happen. And now it's happened, what, 2 or 3 times?
I saw someone else on mute. You can go first.
I think if you look back at his comments, I think, didn't he also say we're not even going to thinking about raising rates till 2024? I mean, come on, you can't really trust anything the Fed says.
Yeah, I just say I'm actually somewhat encouraged by it. I don't like when they say we're not considering raising 75 basis points, because how do you know what the data is going to look like in a month? And the data in a month is going to be the determinant of if you're supposed to hike 75 basis points or not. So they always like to say they're data driven, and to me, and this goes back to that point of jawboning, of saying and that's Sven made very, very acutely, where they say a million things to try to push credit markets where they're trying to go on their own, to try to get credit markets to do the work for them.
I trust the Fed less what they say than a drunk at a bar.
Well, I guess that depends on what the drunk is.
Fair enough. But look, at the end of the day, it's about managing these markets. So that's why I come back to what I said earlier. These incessant speeches, it's almost micromanaging, and as soon as anything goes out of line, you find a Fed speaker that's going to reverse that. So be clear, these markets are actively managed by this committee, okay? And so they're whatever they say may make sense for them to say in terms of managing markets at a given time, but don't be surprised if their views suddenly change at some point. Okay, I'm not saying today, I'm not saying next month. Obviously, there's no Fed meeting next month, but the past experience, and I hope everybody's been paying attention these last 15 years, the past experience shows that, especially if you look at, for example, their Fed funds rate projections. Not a single one of these has come to fruition since they were first published after the financial crisis. Even in 2018, they were still looking at rate hikes, and then obviously they went into rate cuts. So I think everybody needs to be approaching this with some level of caution in terms of what they say and what they will actually end up doing in time.
Yeah, as soon as you see, it's like 2018, what Sven was just talking about, referring to. They can project and talk whatever they want, but if the data gets really bad, in terms of mortgages or housing starts or unemployment, let's say the unemployment rate starts, all these job, layoffs that we've been seeing from individual companies, if this actually starts showing up in the official unemployment numbers and it starts trickling higher to 4%, 5%, it's over. The Fed's not raising anything. I don't care what they've said 2 months ago. They're not. They're going to stop in a heartbeat and turn on a dime, or they're going to change the definition of unemployment to be, temporarily on vacation. That's what they're going to do, something different.
They cut rates 3 times in 2019 with unemployment at 3.6%. Okay, so the mandate thing is a moving target. So I said in 74, 80, 82, they cut rates while CPI was still above 10%. So yes, it's a problem. It's going to continue to be a problem. And frankly, if this energy situation with Ukraine does not improve over the next few months, then yes, it's a major problem for Europe. It's a major problem for the world. And yes, so there is even acknowledged the possibility if they pause and that leads to a major equity rally, that may end up then being a policy mistake and it implodes in 23. Perfectly aware of that as well. I'm just generally saying, whatever they say, don't take it as gospel. They're stating it because they set themselves on a path. They want to be predictable in that sense, but they will flip when they see it's the right thing. And probably just based on history, once we are in a recession, they will flip. Doesn't matter where inflation is at that point. That's what the history says.
Ryan, we're just kind of talking about initial reactions and kind of, faith in the Fed regarding the rate hikes. Curious about your initial reactions here and your response to the hike.
It's very interesting. I'm surprised they came in so doggedly. Full transparency, I was expecting a full 100% BPS hike just based off of the CPI month-over-month jump as well as the year-over-year jump. Last time, we didn't have as violent of a year-over-year jump when Powell came in super hawkish with the 75 basis point hike. So I was expecting, hey, he's going to parallel that move again with 100 basis point. But it looks like he decided not to do it. And I think it's more of a political move than a Fed move here because they're not trying to shake the markets up. They want to have the markets have some time to recover summer and then maybe go back to hawkish mode later this year again into September. But it's very interesting to see what they're doing here with these rate hikes because we have to see how effective they're going to be. The only reason I'd imagine that they didn't go as hawkish as they should have was due to the fact that oil and gas prices have been coming down for 6 weeks in a row so far. So that's the main reason that I see. Maybe they looked at some recent data and they decided to run with that versus in the past where they would only go with the present data that they had from just CPI or PCE. So it's very interesting to see what they did here. But again, it's going to make for a very interesting trading summer because right now we have to realize that we're not going to get any more of these rate hikes till September. It's no more of these big events. The only real big market shaking events will be the CPI data, which based off of it moving so closely with the price of fuel and oil, essentially 1-to-1 now, with it coming down 6 weeks in a month down to about 4.5 or 4.56 average per gallon across the states. I think that next CPI is going to be much better. It's going to come in lower. And then we don't have enough data right now for me to speak on September's. But it's going to be very interesting to see how this is all going to be playing out in the next few months. But I mean, overall, as someone who people like markets that move up more than they like markets that come down. So I'm happy for the overall people that like to see their stocks and portfolios recover if the market reacts positively to this because it was what was quote unquote expected. But again, we have to realize that this is still a 75 basis point rate hike, which means all of the rates will be going up, which means it's going to be harder for companies to borrow money, raise money. And it's still a negative thing across the board because all these companies have to be reevaluated again at these right? So it's interesting to see overall. But I mean, I'm glad it wasn't 100 BPS. I'll say that.
So I'm going to pivot this back to you, Joseph. With the hearing coming up in about 14 minutes here, I want to know what your opinion is on how the Fed will speak about this and kind of the communication to credit markets.
Yeah, so I agree with what Sven and Silver were saying in that. So Powell has a history of being, I guess, flexible and pivoting, especially in 2019. His words for that now are humble and nimble. So I suspect that going forward, he's probably not going to give a lot of hard guidance like he had recently. So what's set in stone is that he wants to get to about, let's say, 3.5% by the end of this year, and beyond that, it's really not clear. And I think what the market will be focused on is how his guidance for next year, if any, will be. Particularly, they will infer that by how he treats the weak economic data that we've been having so far. Is he really concerned about a recession, and does he take that into account in setting his policy when he has to juggle high inflation? So I think that's what I would be looking for, and what the market will be fully attentive to. So from here to December, that's not much is going to happen. Sure, we maybe go 75 or 50 in September, but that doesn't really make a difference. It's really, I think, the path beyond next year that's really more important and worth listening to.
Yeah, I mean, look, the Fed has also a history on not ever calling a recession in advance or even copping to the risk of it. I mean, think back to 2008, Bernanke, adamant no recession in sight, right before the global financial crisis. And so the method that we're seeing right now with recession not as a base case is also political. They don't want to scare markets. That's not something, it becomes a self-fulfilling prophecy as well. And that's a bit of a danger as well, because you get again into this credibility issue of you seeing this data and yet at the same time, they're insisting on no recession. It's a bit method acting here as well. So I would be very surprised if Powell would acknowledge. He may acknowledge, okay, we're seeing some slowing and so forth, but they're going to focus again on the strong labor market because that's their ace card here to say there's no recession in sight. Yellen is coming out tomorrow as well. I think she's going to say something very similar. So they're not going to give any hints on that. They'll admit the recession once the data makes it very clear that we're in it.
Yeah, that's actually a great segue for me, and I'll be super quick. And it was I think Sven, you said it, and I want to give whoever said it credit because it was a great point of demand side inflation versus supply side inflation, and how the Federal Reserve has wonderful tools in their toolkit to destroy demand, to create a reverse wealth effect, to make consumer confidence be near cycle lows. But at the exact same time, in this press conference, the reason that they're trying to combat what's more so supply side based inflation at this point is because they still see consumer demand as frothy. That's the word that they used in the last conference. So that's really what's giving them permission to kind of combat supply side inflation, because they're trying to destroy demand to give supply chains a chance to catch up and take a breather. And now we've seen, my dogs are barking, so let me close the door super quickly. But we've seen Walmart and Target with that famous bullwhip effect, and that's the term we've all gotten to know and love, have large inventory gluts and large markdowns. And also, I just referenced consumer confidence that the University of Michigan releases near cycle lows. So it's hard to see, and Ayesha, you talked about this too, which I wholeheartedly agree with, how this strong consumer lasts that much longer. And we see cracks deepening really, and signs intensifying every single week. So just wanted to make that point before the conference that I'm waiting to hear if that word frothy is used again to describe consumer demand, or if that's removed from the Fed's vocabulary. So it won't be a black or white if they don't say it. I'll make a different conclusion. I'll be using a lot of other context, but that word was really important to me last time, and just wanted to bring that up. And now pass the mic to our smarter speakers.
I'm just going to pop this right open to the entire panel. Looks like the hearing will start in about 9 minutes here. Does anybody have any comments to speak on, equities, like kind of what happened with, Walmart shop, et cetera? Mr. Blond, do you have any thoughts there?
I mean, not anything really that I would consider to be sort of new and super insightful. I mean, I think it's a function of, we overstimulated, which led to overproduction. led to over demand, which resulted in overproduction, leading companies to be over inventoried at a time when you're in the face of demand destruction, which kind of shifted the trajectory of sales for a bunch of companies. I mean, I think what Walmart said was really just a continuation of what they said in the first quarter, and I think it tells us that issue is not yet resolved, which is they have too much stuff relative to the purchasing power of households. I mean, all of this despite two things. One is, if you guys recall, in the fourth quarter of last year, all anybody wanted to talk about was how many ships were stacked up in Long Beach, acting like we had some big supply bottleneck problem and we weren't going to have enough stuff to buy. Well, that certainly doesn't seem to be the case, because now we have more than enough stuff to buy. I think the other false narrative was around excess savings on the part of household balance sheets. I mean, if everybody had so much excess savings, then presumably Walmart and Target and other retailers wouldn't have as much excess inventory that they do today. So I don't know. I mean, I think the inventory problem was one that was building from the fourth quarter of last year, and I think what we're seeing is now being realized in hard data, and obviously the impact that it has on companies like Walmart. And there'll be more department stores and elsewhere will have similar problems.
So I'm going to kick her over to Tracy here. Do you have any thoughts on, what's been discussed so far regarding demand destruction, inventory gluttony?
Again, we're just not seeing demand destruction, regardless of how many times the Fed's going to hike. I mean, even if you look, we had 75 basis points hike, and oil actually rallied on that. And so I think you have to stop looking at this market like you used to look at this market, because this is one of the very first times, or at least in the last 50 years, that we've actually seen a structural supply deficit, and the Fed just can't fix that, even with trying to create demand destruction via rate hikes. We're just not seeing it because a lot of this demand is inelastic, and people don't like to hear that, but that's really the truth. I mean, people still need to go to work, people still turn on their air conditioning, people still turn on their heat, people still, they use all of this energy to survive. So, this is a very unique situation that we've been in over the last, since 50 years ago. So I think you just need to take everything with a grain of salt and look at this market a little bit differently than perhaps we've been used to seeing.
So I'm just going to keep this open to the panel, but Christian, do you have any comments regarding the structural supply deficits and what other speakers have said so far?
Well, first of all, what Tracy said was spot on regarding the last question. Supply deficits, I'm not sure I understand the question, but I think what we're experiencing too, and seeing, what Walmart reported this week, because I think a couple of questions ago you asked about equities, and sorry, I'm multitasking, but I think it's very interesting what's going on with the consumer, right? And I don't think really that there is demand destruction either. I think it really depends on how the consumer is situated. There are some consumers that are really getting pinched right now by the increase in gas prices and also the inflation costs in the supermarkets and the stores. But that's not every consumer. There's a lot of consumers that are sitting fine right now. Maybe they're upset a bit because their stocks aren't going up and their 401ks aren't going up as much. But I think that you've got different consumers that are feeling different things right now. And where I live is in New York City, and you're just not seeing any sort of slowdown whatsoever in terms of either what the individual is doing in and around New York City, and the tourism. There's a lot of tourists. There's a lot more tourists than I've seen the last couple of years in New York City. So that we'll see if that changes. But I think it's important to kind of not get so tuned into what the headlines are and so forth. And make sure that you've got some perspective just to realize that it's not horrible out there. Depending on what group you're in, and again, it's unfortunate for certain consumers who are really feeling the pain right now. But I don't think that is what everyone is feeling. So sorry if that's a little bit off topic, but I just wanted to talk about that as well as what we're seeing in the equity market.
To follow up with, I think, what Christian was saying, if you look at the earnings reports for, let's say, American Express or Bank of America, the consumer spending is very strong. So Amex just came out and said that they had record members spending. The revenue was up 30% year over year. So there are segments of the economy that are doing all right. So it's hard to get a big macro picture, but these big banks and payment processors, they're plugged into the economy more so than any anecdotal data. And their data says that the consumer is doing okay. Okay, with that, happy Fed Day.
Everybody listening, follow the speakers you've listened to today. They are invaluable folks in this space. Tons of information, always educating, always being helpful. I'm curious on your guys' thoughts, especially on his comments that he said multiple times there that we are not we're not in a recession right now. Do you agree with that?
That was very funny. It was every time one of the reporters said the word recession, he could just take a shot and by now he'd be just blackout drunk. He avoided that like a pro. He finally said that he doesn't think we're in a recession. But I mean, all the data is pointing to, all the data in every economics textbook, even if the White House tried to redefine a recession, but all the textbooks that I was looking at the other day for my old economics classes, there was all the two negative GDP readings. However, though, he is correct that sometimes they do come back and they revise GDP readings because one thing we have to remember is we get two preliminary ones and then we get a third one. And really in September I forgot what his name was. He's not on the panel anymore. He was mentioning that the Fed won't admit that we're in a recession until for a little bit later. And I think when we finally get that final Q2 reading in September, that's when the Fed will have to admit that we're in a recession, and then that'll be on the heels of the next FOMC. So I think it's going to be really interesting there. But he did do a masterful job of avoiding it, and he kept propping up the labor market there. But, I mean, it's J. Powell being J. Powell. It said a lot, but didn't say much.
Beautiful. Thank you. Gordon, thanks for joining us here at the end, man. What do you got? You can say anything you want, man. Really open to your perspective here.
Hey guys, thanks for having me in. So I'm no Fed expert, but I do speak to a couple, and I think that their viewpoint was on the release, the unanimity, or I guess the consensus view that 75 basis points, they saw that as somewhat hawkish. They were expecting Powell. They said there were two things to look for in the comments, whether he would admit that recession was likely. He didn't. So they saw that as hawkish. However, they did say that him saying at some point rates will go up or come back down, that was a bit dovish. But I wanted to get in before the meeting because I think there's some key things to look at, right? So clearly what he's looking for is a slowdown in overall activity. And I think that the way that happens is you get inflation moderation through demand destruction via households who can no longer afford price increases. And I think the way to do that is three-pronged. Via credit, via wages, and via wealth. And if you look at those three dynamics right now, you have credit growth at near an all-time high, wage growth at a record high, and wealth at an all-time high. So it just seems to me like if they're really focused on fighting inflation, which it seemed like he said they are, to really get things under control, they are looking for actually negative economic data points. And clearly, since the last meeting, one of the reporters said things have tightened. That's not true. If you look at the 3, 10, or 30-year bond, like since the last meeting, things have loosened. Yields have gone down. So it seems to me like they're going to have to be more aggressive. Just my take, if that's helpful.
So he did mention during the speech that he expects, the potential for more unusually high rate hikes. Do you think then, based on what you just said, we are looking at a potential 100 in the near future? Or do you think it'll stick to 75?
I can't say whether it's going to be 100 or 75. But what I will say is the Fed whispers I've spoken to, they were 100% confident it was 75. And when I told them there were guys out there saying 100, they said that was utterly ridiculous. And they said to look for comments in this most recent, I guess, chat from Powell on what he was doing for the balance sheet. It looks like he said he's going to be more aggressive with respect to reducing the balance sheet. And I think some people may have gotten a bit ahead of their skis, if you will, on the balance sheet, because keep in mind, the MBS bonds take 3 months to basically work out. So the balance sheet reduction is not going to be like, as steady and non-lumpy as people expect. So I think people may be surprised. The bulls may be surprised negatively in future balance sheet reductions.
So just to open it up to both of you real quick before we let everybody off the hook of the space here. They've been here for a couple of hours now, but I did want to pick both of your brains. Whoever wants to answer first, feel free. But based on everything that we now know with the release of the FOMC, with the hearing, with what you both just said, Jay Powell said during the questions that we do appear on track, depending on how things go moving forward, to get down to that 2% inflation goal. Do you agree with that? Are we actually on track to get down to 2% anytime in the near future at all?
Yeah, I think absolutely not. Again, to get to 2% inflation, you need credit growth to slow significantly. We're looking at record year-over-year credit growth. You need wage growth to slow significantly. At 6.7%, you're looking at historically high wage growth, and wealth is sitting at an all-time high. And in addition to that, again, since the last meeting, yields have fallen, meaning credit conditions have loosened, not tightened. So I think they need to be much more aggressive in hitting 2%. So them continuing to focus on 2% would suggest, in my view, that they're going to be getting more aggressive.
Yeah, I have to agree there with Gordon. I don't think we're anywhere near on track to get to 2%, especially with what's going on in the markets. Gordon's hit the points with the nails right on the head. I discussed this in a video that I put out earlier too. Is like the Fed keeps saying we're going to get to 2%. The Fed keeps saying it's going to be a soft landing. It's going to be a soft landing. But then when you go and look at the New York Fed or the Atlanta Fed and the data they're putting out, the New York Fed put out a piece in May. I did a full video on it. I posted on my page as well, that there's an 80% chance of a hard landing. And then there's very little chance of us getting to 2% very quickly. I think what's going to happen is either they're going to push their date for the 2% out farther, or they're going to come back and revise and say, hey, we're going to be aiming for 4% now versus 2%. And then later on, we'll tackle 2% because maybe we'll start seeing negative economic impacts in the markets. But I mean, we are nowhere on track to get to 2%. I mean, everything is just raging still.
Yeah, and one last thing I'll say, Ryan, and thanks for that. And I agree 100%. But if you look at nominal spending, which is again fueled by wealth, wages, and credit, it's still growing at an accelerated clip. So it's clear that there's a way to accommodate it. So I actually agree, Ryan, that the Fed whisperer I spoke to said that they might take up their neutral rate. Clearly, they didn't do that this meeting, but I think that's in play near term, based on the Fed whisperer I speak to.
Yeah, I agree 100% with you. I think that the other thing that we didn't get this meeting that we'll probably see the impact and effect of is we didn't get a table of economic projections. That we get one every other meeting, but what happens is you get the meeting minutes the following month, which has like it in a text format of some degree. We saw the impact of that 2 meetings ago when the Fed meeting minutes came out. And we saw that they had in those meetings said that they're going to be aiming for a higher Fed rate by the end of the year. And I think we might even see that again, because I think what's happening right now is they want the markets to kind of melt up into the summer, let people cool off a little bit. But what could happen negatively is if CPI numbers, or in their case, they keep saying they look at PCE. If PCE keeps coming higher and higher, in September, they're going to have to come in even more hawkish. And we might see that 100 BPS or another few 75 BPS rate hikes to kind of get there. But they're nowhere near that 2% inflation rate, or on par with the 2% inflation. I think that was just something they put out there. Didn't expect that they would happen. Plus, we have to take into account the whole Russia situation, which ran up energy prices significantly. Energy prices were going up, but that added fuel to the fire. And then I feel like they set a target where they're kind of got their feet stuck in the sand with it.
Beautiful. Thank you guys both so much. I think that's a good stopping point for us. Thank you, everybody who came to listen. If you're not following the array of speakers we've had, you absolutely should. Gordon, thanks for coming in to close us out, as well as you, Ryan. For those of you that missed or came in late, this is recorded both here on Twitter. It'll be on Unusual Whale's main page on the same posts that he announced in this space, as well as the Unusual Whales Twitch, twitch.tv/Unusual Whales. This will be the last one of the week for us. We'll be back again next week, I believe, for an oil and gas discussion. Thanks again, everybody, for coming. Follow everybody you saw up here. Missing out on a lot of info by not doing so. And we'll see you all next time. Thanks again, everybody.